Hi, welcome back to part 4 in my series, How to Create Tax-Exempt Income in Retirement. Part 4 is titled, How Money is Taxed in Retirement. Now, let's say we have 3 brothers that are triplets, and they all begin saving for retirement at the same time, and they all decide to retire at the same time. And let's say that we've got brother 1, who's done his retirement planning fully in the taxable bucket. Brother 2 decided to put his money in a different investment. We're going to call it partially taxable. And brother 3 he decided he was going to put his money in the tax-exempt bucket. Now, let's say brother 1 and brother 2 and brother 3 all decide to pull money out at the same time, and they all want to pull out $80,000. Okay? If brother 1 pulls $80,000 out of a fully taxable bucket, like 401ks or IRAs or rent properties, or maybe he's still working, other forms of income. Maybe he's got a side job. He pulls $80,000 out of a fully taxable bucket. The first thing that happens is federal income tax. Now, we're going to assume a 25% federal income tax across the board because that's about an average tax rate for most retirees. 25% of $80,000, we know, is $20,000. So that's going to leave brother number 1 and his wife $60,000. But he also has Social Security. Now let's say, since everyone's Social Security is different, let's just say that he and his wife have $40,000 a year in Social Security. Would you assume that at this point, brother 1 and his family would enjoy $100,000 a year in retirement? If you do, it's understandable. But the problem with that is federal government decided in its infinite wisdom in 1983 that we didn't need all of our Social Security. That is, if we had other forms of income in retirement. So they decided that they were going to tax your Social Security if you had a certain amount of what they call provisional income. Now, there's 2 plateaus. If your provisional income is over $44,000, which $80,000 is, then 85% of your Social Security is now going to be taxed. So they don't get to keep all $40,000 of this. 85% of $40,000 is $34,000. $34,000 taxed at 25% is going to be $8,500. Leaving brother number 1 and his family with $91,500 after the taxes were paid. This is an unnecessary tax because of where his money was in retirement. He created it. Now, moving on to brother 2. Brother 2 decided he was going to open a business, buy stocks and bonds, buy land or real estate. And then come retirement time, he would just sell it. Now, if he sells and generates $80,000 a year, he's not taxed on all of that, is he? No. We've got to compute a cost basis. Now, obviously, every cost basis can vary wildly. So for sake of our illustration, let's just assume a 50% cost basis on all assets. Leaving brother number 2 and his family with a $40,000 gain in the sale of their $80,000 asset. Now, if these assets had been held for more than 13 months, this is going to be considered a long-term capital gain. And according to today's tax code, they're not taxed the same as ordinary income. So, long-term capital gain, 20% is the highest long-term capital gain today. So if we assume the highest of 20%, we're going to take 20% of the 40,000 as a long-term capital gain tax, bring our cost basis back in, and brother 2 and his family have $72,000 of the 80 left over after they've paid capital gains. Now, like brother 1, he and his family have a $40,000 Social Security check or checks. Again, we have to figure what his provisional income is. His provisional income is less than the $44,000 threshold. So he's not taxed on 85% of his Social Security. He's taxed on 50% of his Social Security. 50% of 40,000 is 20,000. We know that. $20,000 taxed at 25% means that there's a $5,000 unnecessary tax that brother 2 has to incur. This leaves brother 2 and his family with $107,000. So right away we see that he's got more retirement income, spendable income than brother 1. Brother 3, he's been in the tax exempt bucket the whole time. He pulls $80,000 out. What do you think his tax is on that? Obviously, it's tax exempt. Name speaks for itself. There is no federal income tax. If it's tax exempt, is there any capital gain? No. He and his family enjoy the full $80,000. Now, he also has Social Security. Where's his provisional income? There is no income. There is no tax offset of his Social Security because he has no reportable income, no provisional income. Brother 3 and his family gets to keep all $120,000 in their retirement. Now, he could be doing a Roth IRA, but there's limits on how much you can put into them and limits based on your income as to whether or not you can actually put money in a Roth IRA. If it was very late in life, if he'd expired everything else, reverse mortgages are non-taxable. If he went and took a loan against his brokerage account like somebody like Warren Buffett does. Goes and borrows against his brokerage account, buys an asset, sells it, makes a profit, puts that money back into his brokerage account. Did the loan from the brokerage account cause any taxation? Margin loan? No. The other way to do bucket 3, certain types of specially designed life insurance. Bank of America has $26 billion of cash values in this. The wealthiest people in the world have been doing this for years. That's how they've been able to maintain their wealth, is by using something that never incurs a taxation. Now, if you'd like to tune in to part 5, we will discuss capital equivalent value, how life insurance can outperform your 401k in the next segment. But that's all for part 4, how money is taxed in retirement. Thank you, and I look forward to seeing you next.